Never in my 5 years, almost 6 years in crypto now, have I ever seen the market this confused and divided on where we are at in the cycle. We have one half of crypto Twitter that believe the bull run has not even started yet. And then you got the other half that think the bull run is over based on the 4-year cycles and everything. So that's what I'll be covering in this presentation. We've got a lot to go through. It will be boring, but this is going to be the most important video you could watch going into 2026. If we go into a bear market and things get worse from here, you need to be paying attention to lower your risk and protect yourself. But if things are looking positive, which we definitely could be making new all-time highs, then you need to position yourself before that move. First, I'll go through why the market crashed and what the influencers got completely wrong. Then I will discuss the Fed meeting that changed the outlook for the short term, as well as all of 2026. And then I'll be sharing some research from one of the world's top macro analysts. So this guy, he has a research firm purely focused on global liquidity. So this is very insightful and you want to stick around for this. He also has some predictions for 2026. And if you stick around to the end, I'll share what you need to be looking at in January. That will give us a much clearer picture of what 2026 will look like. Let's get right into it. I'll try to keep everything as simple as possible. I don't want to ramble too much, but we all know why the market has been struggling in global liquidity. So as you can see in previous cycles, we had a massive liquidity increase in 2017 as well as last cycle. But then from 2022, you can see we just went nowhere. Liquidity went down and sideways, and we only made a new all-time high earlier this year. And then even when we made an all-time high, we only seen like this much increase. And you can see this zoomed in that like all year we had a decent increase, but then we kind of topped out and started to roll over. That caused fear that maybe liquidity had topped out. And if liquidity topped out, then that means crypto's going to shit, right? We do not want to see liquidity to go down. The rate of increase in liquidity slowed down, and that's why markets crashed, and that's why we've not seen any alt season. We haven't seen any frothiness and euphoria in the crypto markets because there's been no liquidity to support that. So what caused this? Well, we had most major central banks pull back at the same time. This is more for the recent history. So Europe been letting their bonds expire without replacing them, shrinking their balance sheet. So that's contraction, not liquidity injection. China was actually injecting stimulus early in the year, but they slowed down towards the end of the year. And then Bank of Japan, they started raising interest rates, which is the Japan carry trade. So what is the Japan carry trade? I'll try to keep it simple, but Japan has had near zero interest rates for decades. So you could go to Japan and borrow free money. So as an investor, you could go and borrow Japanese yen for free, essentially, and then swap that to the US dollar, which was stronger than the yen. And you could then go buy US assets or buy US treasuries. So US treasuries is where you give money to the US government to pay off their debt, and then they give you interest, like a 4% yield per year. So there was $20 trillion in borrowed yen in the US stock market and treasuries. So obviously, while Japan are hiking the interest rates, this means that the money is becoming more expensive and no longer free. And if they now need to start paying interest on this borrowed money, well, they are going to obviously start taking profits to pay back interest, or they might close their investment entirely if there is no longer a return on investment. So this just equals more sell pressure on US assets, and that can obviously cause a crash and a lot of fear and more tightened in liquidity. So every Bank of Japan hike this cycle, we have seen a crash, and I mean, a lot of this crash was also caused by the fear of them hiking interest rates again. Even if they continue hiking rates, like, yeah, we could see a bit more downward pressure. But the thing is like markets are forward looking, and markets have already predicted that the Japan will continue hiking their rates. So a lot of this is already priced in. How much more worse can it get? Because everyone's already predicting it. Whereas like here, like no one even knew what the Japan carry trade was. Then we've got the US dollar gain strength. So this is not good for markets because everything priced in dollars are now more expensive when the US dollar goes up. And countries with US debt and companies, they now have to pay more to service that debt, especially when interest rates are higher. So a stronger dollar just means tighter financial conditions again, which is bad for crypto. So from September, we trended up, and we have now started to make a downtrend, and we're actually like going down, which is good to see. But that was a reason for the struggles all year. And then especially towards the end of the year. And then we had the government shutdown, the liquidation event in October, which definitely broke something in my opinion. There's probably a market maker or something that has had to force liquidate and recoup funds. And then leading into November, everyone was predicting that there was no rate cuts coming and that we were not getting QE, so that obviously was not positive. So I want to just remind you guys, like, this is the worst tightening cycle we've seen in 40 years. So of our generation, this is the worst tightening we've ever seen. And to prove this, in the Purchasing Managers Index, this chart pretty much is like an indicator of where the economy is at. This is when the economy has money, everyone's frothy, everyone's spending money, stock market's doing well, crypto is doing well, like that's when things get frothy. But down here, this is when everyone's feeling broke, interest rates are high, and no one's spending money. You can see it's like a heartbeat monitor. It's very up and down, up and down. It follows pretty close to the 4-year trend, based on global liquidity as well. You can see for the first time ever in 70 years, this goes back to 1948. So the first time in like 70 years that we've ever seen a flat line. We've never seen this before, ever, especially below 50, because 50 is the baseline. Anything below 50 is where the market's kind of struggling. Anything above is where things get a bit frothy. So the fact that we've been, ever since 2023, we've just flatlined. That's just more evidence that this time really is different. Like the macro outlook is completely changed and the liquidity cycles have changed. Then we had the repo market. The repo market is the Fed's emergency lending facility. So when banks have expenses to pay their withdrawals and whatever, sometimes they need to borrow money from each other to pay off their expenses. When the banks are struggling and they don't have money to lend to each other, well, then they go to the Fed. The Fed's repo market, which is the emergency lending facility. So this got tapped a few times, multiple times in Q4, whereas the last 2 years never got tapped. This is just a sign that there's not enough money flowing through the system, and it's a sign of stress. What's crazy about this repo market stress stuff is you have influencers like these guys talking out their ass. You really need to be careful of who you trust online, because these guys have hundreds of thousands of followers each, and these are supposed to be the experts that people look up to, and they are giving completely inaccurate information, because they're talking about this repo injection as the second largest liquidity boost since COVID. And here again, biggest liquidity injection ever. 6th largest liquidity injection. Like, they're all copy pasting the same shit, and these guys even have the exact same screenshot. And the reality of this is that there was no new money created. This was not QE, this was not stimulus. It was just an overnight repo operation where banks temporarily swapped treasury securities for overnight cash. And you can see here the trade reversed the next day. So you need to be careful who you trust online, because if you're going to make investment decisions based off this, these guys are brainwashing you and just telling you positive things and the things that you want to hear, because they are engagement farming. So if anything, this is super bearish. It shows funding stress in the system, as I said before, and this is not bullish QE. There's nothing bullish about this. So yeah. So if you can't trust these guys, who should you listen to? Well, you shouldn't listen to some random guy on the internet, me, about macro and global liquidity, because I'm not the expert. I have obviously been studying and learning about global liquidity through my 6 years in crypto, but I'm not an expert. I haven't been doing this my whole life, and this is not my main focus. So for me, I want to follow the expert. And when it comes to global liquidity, Michael Howell is the guy. So I searched Grok, how important is this guy? Grok said that he's a leading expert on global liquidity, often called the pioneer or godfather of the concept. Like, he essentially invented the term global liquidity. So yeah, one of the most respected macro analysts in the world. He developed the global liquidity analysis framework in the late 80s and 90s, runs Cross-Border Capital, which is a dedicated research firm just for global liquidity research. And he's been pretty accurate in forecasting tops and bottoms every single bull market. And when it comes to global liquidity, this is your guy. So something important to note is going into December, he was actually bearish. So he saw liquidity decelerating, stalling. So he was not bullish by any means, and he definitely was concerned. But then the Fed meeting happened. So on December 9th, we had the Fed meeting that changed everything. So they cut interest rates by 25 basis points, which is bullish, and they expect inflation to come down. So this is key, because if inflation comes down, well, that means they are allowed to continue easing and stimulating and bringing down interest rates. So the labor market is looking really bad as well, which is a really good thing, which I'll explain on the next slide. But overall, much more positive, brings back hope in continued easing and liquidity expansion going into 2026. So why is a bad labor market a good thing? Well, it forces the Fed to keep cutting rates and stimulate the economy to prevent it getting worse. If the labor market is strong, well, they have to keep rates high to focus on inflation instead. But if the labor market is weak, well, they need to focus on the economy over inflation. You can't do both. You have to choose one or the other. So they either focus on bringing inflation down or they help stimulate the economy, because if they stimulate the economy too much, that brings inflation up. So it's a double-edged sword, and they just have to pick and choose what's going to be their biggest priority, right? So if the labor market is weak, they will keep cutting rates and they inject more liquidity. And at the last meeting, Powell basically said that we need to make sure our policies are not pushing down on job creation. So him mentioning this at all just shows he is now prioritizing the economy over inflation, whereas previously he didn't care about the economy, he only cared about inflation. So that was his main target. So yeah, it's really good to see that they've switched stance. And then they announced a surprise announcement, which was the reserve management purchases, or RMPs for short. This is a new thing that they've just started doing, and it's 40 billion treasury bill buying every single month, and the first one happened on December 12th. So this is definitely expansion, but this is not crazy QE. It's not like we're getting crazy stimulus. You could call it stealth QE or light QE. They also announced unlimited repo backstop. So where I mentioned over here, the repo market, they did have a cap at 500 billion, but now it's unlimited. And so this is a safety net to prevent a repeat of 2019 when the market collapsed. And what does this mean? Well, the Fed is willing to step in and provide liquidity when the system needs it. So again, it just shows the Fed is prioritizing the economy and they don't want to break the economy essentially. So that's all good for crypto. And after this Fed meeting, Michael Howell, he switched his stance. His response to the meeting was that he projects stimulus going through 2026, anticipating a significant rally, expanded monetary stimulus from both the United States and China. So it's very bullish to see that, especially considering he was bearish and now he's flipped bullish. And yeah, he's happier than he was before. This is a liquidity injection, no question. And he named the article, "We're buying Bitcoin on weakness," as you can see here. So yeah, this is one of the world's renowned global liquidity experts. He's like the #1 expert when it comes to global liquidity. So, I'm not going to say, listen to me, I'm not the macro expert, but I like to look at who actually has success and who's actually credible in these markets. And my job is to filter out the noise and provide you value, not engagement farming and telling you trash like these guys. So let's get back to it. So we have many bullish catalysts for 2026. Obviously, we've got Jerome Powell replacement, most likely to be aligned with Trump's vision with stimulating the economy, some more rate cuts, more stimulus, more QE, and the repo facility now unlimited. All of this just means we're going to see Fed balance sheet expansion versus contraction like we've seen all cycle. So this is a very, very different scenario when we're talking about the Fed and liquidity and the economy and all this. So that's great to see. And we'll have the People's Bank of China expected to ease their economy. We also have Trump, tweeting about his $2,000 a person stimulus check. So that should kick in 2026. We've got tax rates coming. So he's cutting taxes entirely from certain things and he's bringing down taxes. And he's also talked about making capital gains and Bitcoin tax-free. We've got deregulation and their focus on the economy over inflation, as I mentioned earlier. And then the fact that we've got midterm elections next year is massive, because if markets don't pump while Trump is in office, that'd be a failure to his legacy. Going into the elections, he needs markets to go up. And yeah, he's ending tariff tensions, he's already ending them, and he's pushing for pro-crypto administration. So, and just to top that off, Michael Howell projects that we're going to see significant stimulus and liquidity injections, which is obviously positive for Bitcoin. The liquidity expert, he thinks that 2026 is going to be much more positive than 2025. I won't go through this, but two Fed officials basically just saying that we're going to see expanding balance sheet and they're accommodating for economy growth. Now I want to talk about why this time really is different, because it's easy to say that. It's what we all want to hear. It's what we're all hoping for. And some people will say like, oh, you're delusional. You're hoping there's going to be a bull run and hoping for alt season. But the thing is, like, yes, we have passed the 4-year cycle, but liquidity has changed and it has not followed the same pattern as it has for 70 years. And this time really, really is different, and you cannot debate against that. Like, you're going to go argue against the #1 expert when it comes to global liquidity. I wouldn't think that's a wise move. So anyone like that is pure bearish, that think there's no chance of a bull run, they are clearly not looking at the data. If you want to compare like 2021 to the current cycle, well, you got to remember that in 2021 up here, like all through here, they're talking about quantitative tightening, and then they hiked interest rates right here, and that was the start of the bear market. So they started hiking, and all of this was contraction. In fact, if we go to the full chart, they hiked interest rates here, and then they were contracting all through here and all through all of this, because this entire cycle we've been in quantitative tightening, whereas last cycle all of this was quantitative easing. All through here we had crazy stimulus, we had QE, but we've had nothing this cycle, and QE and stimulus is only starting right now. Like the main driver that caused this whole bull run is just about to start. So you can have your own opinion on what you think that might do. So I just want to make it clear that this time really is different, because the last cycle ended with quantitative tightening, and right now it feels like this cycle is ending, but we're just about to start quantitative easing, not tightening. So very, very different scenarios when you're talking about macro and the economy and everything. You can see like, we are flatlined, and as soon as we start going above 50, that's where we'll see frothiness, and it will go to up here at some point. Like this does not stay below 50 forever. Well, that's when we should see crypto being a little bit more exciting. And yeah, I really think that 2026 should be what most people expected 2025 to be. So the best is still ahead. And just another reminder that this is a setup every investor dreams of. The dream is to get positioned before the liquidity wave hits. Like you want to be buying down here, before the frothiness in the economy, and that's how you make money. So what's the bear market case? Because obviously there is a chance we see a bear market. Let's not be delusional here, because anything is possible. So some things that we do not want to see is a strong labor market. So this would give the Fed less reason to do stimulus and quantitative easing, and that would just mean like a repeat of 2025, where we just have paused rates and continued tightening and whatever. Although we do have the RMP liquidity injections, so that's a lot more positive than we've had for the last 2 years. And then US dollar gaining strength will not be good. We don't want to see the Bank of Japan hiking rates aggressively, although this is already expected. And repo market stress continuing won't be great, but again, this won't send us into a bear market itself, but it's just not positive. And Fed turning hawkish again, but that would be a result of this. But at the end of the day, the only thing that really matters is how does the Fed respond to any of these happening? So if any of this happens, it's not like we are going into a bear market, because the Fed can always respond and cushion the impact. So this is what matters. So what's my plan for 2026? Well, right now we're just in wait and see mode, because it's impossible to know for sure where we are headed until we get more data in January. And yeah, I'll be playing defensive, preserving capital for the time being, and a lot more Bitcoin and Ethereum exposure compared to previously holding a lot more altcoins. Regardless of what liquidity does, Bitcoin and Ethereum are gaining real institutional adoption. So Bitcoin did this even through all the tightening and with zero liquidity ejections. And it's just a reminder that like, regardless of what liquidity does, these are your two best assets that could still perform, or at least hold up a lot better than altcoins. The days of just holding a bag of altcoins and just forgetting about it is no more. So yeah, you want to be holding Bitcoin and Ethereum. Not financial advice, of course. I'm still very selective with high conviction plays only, and trading strong trends and narratives. And I'm staying away from the meme coin trenches. When I say trenches, I mean like trying to trade a 50K market cap shitcoin to like 300K, because this is not the conditions to be doing that. And this is what we want to see going into January. We want to see China stimulating. They typically do this in January. We want to see the Fed continuing to prioritize jobs over inflation, as they currently are. We want to see more QE, and the RMPs actually improving liquidity, not just plugging holes. And we want to see the US dollar weakening. This would be a bonus. And we want to see Bank of Japan pausing rates. That would be another bonus. And ISM breaking above 50. That's where we should see things starting to get frothy. Now, I want to leave you with a quote or a lesson from Charlie Munger. I don't think this is the exact quote. It's found on Twitter. One of the world's most respected investors of all time. The big money is not made in the buying or selling, but in the waiting. Fortunes aren't made chasing manias. They're made sitting through misery. The market has no reward for tourists, only for those stubborn enough to stay. When the tide turns, it turns fast. The only question is whether you're still there to see it. One green month erases months of red. but only for those who didn't flee the table. And the reason why I wanted to share this is because if you look at where we are currently, the market is not looking good. And this is where everyone tends to give up. And I see it firsthand with my crypto community that I run, because I see when people join and when people quit. And this is a perfect indicator of the public sentiment when people are getting scared and they give up on crypto because they leave. And then I see up here, this is where everyone starts to join my group, because this is where they see all the wins, all the testimonials, all the results. They see everyone else making money. They see all the hype and excitement. And then they decide to take action and get involved in crypto. But then they buy up here, they might start losing money. And then during this period, they give up, which is like the complete opposite mindset. And yeah, the reason why I'm sharing is because this is a time to pay attention. Just like down here, when everyone else was giving up, when the market looked like shit, everyone was freaking out. Well, down here, we found some of the best opportunities to show you. I called Abster at 800K. I think we called it on the dip at 400K as well, but this was on the 26th of February. So this was like right here. This is when everything looked really shit. And this wasn't some random meme coin gamble. I provided a full investment thesis on this. I even wrote an entire Twitter thread. So you can go and follow me on Altcoin Junkie on Twitter. I was the very first person on Twitter to write a full thread as well. I was the first person on TikTok, first person on Instagram to talk about abstract chain as well. And yeah, I turned $2,700 into $155,000 in the space of like 6 months. So you can see where I withdrew, deposited Ethereum, and like on just this week, I was up 50K. So obviously I didn't cash out all of this. I didn't take profits at the top. I definitely took some profits, but I cashed out like maybe 1/3 of this. All in all, I still made a significant return on a $2,700 investment, and so did a lot of other people in the community. Flynn go from 5 to 100K, and I don't need to go through all the rest of them, but you get the point. We printed on abstract chain, and the thing is, like, this was during the most scary time of the market when everyone was giving up. This is when the Solana trenches were just looking horrific, and this is where we doubled down. And then we end up finding more opportunities. And since everyone was giving up, a lot of people missed out on this opportunity. And so my point I'm trying to make is that when the market is going through these bad periods, this is the time you need to pay attention, learn, stay up to date, lock in, and these are the times where you end up finding the opportunities. If you're interested in joining my community, you can check the link in the description, 50xclub.com. You can have a read, watch this video here. This explains more about what we do. Watch the video testimonies. We want to grow a community where everyone is working together. Like, we reward members for providing value in the group. This is a place where we share research. Everyone can contribute to the research. Like, this is what we're trying to build. So we've been running for almost 2 years now, so you can check us out. And yeah, if you enjoyed this video, I've got plenty more coming. And I'll keep you guys up to date with Michael Howell's research, as well as any opportunities that we might find. So if you enjoyed the video, please like and subscribe, and I'll see you on the next one. Peace.